Hey everyone, your go-to channel for breaking down the biggest financial stories with no fluff. Today is our last episode, so today we're going to be recapping the market overview of the last week for the last time. We've got three major headlines: a shakeup at the Fed, earnings drama in Europe, and Elon Musk's ever-expanding empire. If you're an investor, business owner, or just love staying ahead of the curve, stick around. This could impact your portfolio. Now let's jump in, again for the last time. So first up, all eyes are on the Federal Reserve. On January 30th, President Donald Trump nominated former Fed Governor Kevin Warsh to replace Jerome Powell as chair. Powell's term ends in May, and this comes at a tricky time with inflation still high and rate cut debates raging. Warsh served as a Fed governor from 2006 to 2011, where he was seen as an inflation hawk pushing for tighter policy. But lately he's echoed Trump's calls for lower rates, creating some mixed signals on what his leadership might look like. This nomination is huge because the Fed's independence is key to controlling inflation and keeping markets stable. Investors are wondering, will Warsh bow to political pressure for quick cuts or stick to the Fed's guns? Meanwhile, producer prices jumped more than expected in December, adding fuel to inflation worries. The combo of new leadership and sticky prices has markets on edge. Now, how did markets react? Cautiously, with a dash of risk aversion. Classically, US stocks dipped, the Dow fell 0.36%, S&P 500 down 0.43%, and Nasdaq dropped almost 1%. Treasury yields climbed, especially longer dated ones, hinting at tighter policy ahead. Small caps got hit hard, with the Russell 2000 down 1.6%. On the flip side, the US dollar strengthened after hitting a 4-year low earlier in the week, signaling confidence in Warsh's credibility. Financially, this means recalibrating rate expectations. Futures still price in 2 cuts for 2026, maybe starting in June after Warsh takes over, but his criticism of the Fed's balance sheet could mean faster shrinking, pushing up long-term rates and adding duration risk for bond holders. Businesses relying on cheap loans might face higher costs, especially in capital-heavy sectors. Consumers could see pricier mortgages and loans, slowing spending. Globally, a stronger dollar squeezes emerging markets with dollar debt, but Warsh's rep might stabilize international flows. Now looking forward, it's about balance, political vibes versus the Fed's mandate. Expect gradual easing with balance sheet tweaks, keeping long-term rates higher. Senate confirmation could drag on, adding volatility. Now bottom line, continuity over chaos, but watch for short-term swings as inflation and White House Fed tensions evolve. Now let's shift gears to Europe, where earnings momentum clashed with policy and geopolitical jitters. On January 26, European stocks edged higher, with the Stoxx 600 up 0.2%, its best in over a week thanks to financials. Banks led the charge, up about 1% as earnings rolled in. Deutsche Bank reported a 5% profit bump, Lloyds jumped 12%, and overall sector earnings are eyed at 4% growth per LSEG data. Banks are a bellwether for Europe's economies, signaling credit health. But caution ruled. US-EU trade tensions over Greenland and tariffs loomed, plus broader geo-risks. Sector-wise, miners surged 1.6% to highs not seen since 2008 on safe haven gold demand. Defense stocks oddly dipped 1.6% despite tensions. Now, let's go to company highlights. Ryanair down 2.3% post-earnings, Danone hit a 1-year low after a baby formula recall, Airbus fell 2.1% on geo-risk warnings, Puma though rebounded 16.9% from prior losses. Currencies added pressure, the yen hit a 2-month high on intervention speculation, dragging the euro down 0.7% against it, hurting exporters. Implications? Earnings quality is king now, but not macro hype. Strong bank results highlight resilience in high-rate worlds, but Airbus-like warnings flag operational risks. A weaker euro complicates supply chains. Looking forward, Europe's stuck between optimism and reality checks. More bank earnings ahead, plus US Fed and tech signals like Apple's cost warnings and Microsoft's cloud miss, will influence. Expect selective picks over broad rallies, with volatility from earnings, policy, and headlines. And finally, the Musk empire. Talks heated up about consolidating Elon Musk's companies, with SpaceX nearing a deal to buy xAI, his AI startup. This fits Musk's vision of AI powered by space-based data centers for energy efficiency. Both are private, so it's quite straightforward, but involving Tesla? Well, that's a company that's publicly traded at over $1.4 trillion cap, needing shareholder nods and valuations. Tesla's shifting from EVs to autonomy and robots amid sales dips. Now markets, Tesla shares rose 3.3% on the 30th, but no big repricing for a full merger. Investors see it as a long-term speculation. Financially, SpaceX-xAI makes sense. SpaceX eyeing a $1 trillion plus IPO. Tesla's PE over 200 dwarfs peers like Meta or Microsoft at 25-35, so acquisitions could dilute value and transparency. Strategically, Tesla needs computing power, which SpaceX could provide via satellites. Now, outlook of it is incremental ties over mega mergers. SpaceX-xAI advances AI without Tesla headaches. For Tesla, focus on execution in autonomy and margins. Musk's vision aligns tech-wise, but structural mergers, especially with Tesla, are distant and dicey. And that's it for today. There you have it. The Fed's leadership pivot, Europe's mixed bag, and Musk's integration dreams. Markets are navigating uncertainty, but opportunities abound for the savvy. What is certain though is that this is going to be the last of its series, and it has been fun, it was great, and hopefully we'll see you next time, but in a different kind of video. So thank you so much for watching. If you have been keeping watching from the beginning or somewhere in the middle, we are very grateful to have you.